Last week, we talked advanced concepts and objections, covering chapters 14 through 16 of Becoming Your Own Banker by Nelson Nash. This week, we conclude this series with chapters 17, 18, 19, and 20, as well as our own personal commentary with what we see in this book and how it relates to what you can do today with an infinite banking policy. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
Let's kick off chapter 17, where Nelson talks about an even distribution of age classes and how IBC can be structured for intergenerational wealth planning.
In effect, what Nelson goes into in this chapter is how you might start policies on your children and grandchildren while they're young. And when you do this, one, you have minimal expenses on those policies. And two, you have this ability to continue funding them for a long time and having policies when the older generations, this is where that even distribution of age classes, the older generations will have some policies, the middle generation, the grandchildren. And eventually, as the older generations pass away, these funds from the death benefit can be used to fund the subsequent generations and so on and so forth. This can be done perpetually to continue to grow your family bank and really create some generational wealth.
Yeah, Nelson Nash was a forester by trade originally. And so he likens this to designing a forest to put out perpetual yield. You let the trees grow. You plant trees in different years in different sections, and they mature at different times throughout your life, so you harvest them as needed. Same thing with these policies. Growth in the policies and the death benefit gets harvested, and that harvest sustains the next generation, or at least it gets that next generation going.
And that's really how you end up with these legacy results that he talks about. A policy established on a grandchild early can eventually yield massive tax advantage passive income, something like $225,000 a year, while still delivering a large tax-free death benefit to the next generation. However, I do want to caveat, and we'll get more into this on some of the other points that we make, but some of these numbers, you got to take a little with a grain of salt. It was a different interest rate environment, and some of the numbers are pretty high. It's not to say that these policies aren't fantastic. A lot of the concepts still apply, but the numbers are probably going to be a little bit different with modern designs and modern yields.
Yeah, not so much the problem being the modern designs, but the dividend rates back then were between 8.5%, I think, when this book was published. And we're hovering in our best policies right now. Dividend rates are running 6 to 6.5%. So that's a significant difference.
That might not sound like a large number, but when you factor in compound interest, it ends up being a massive difference. So that is something to consider with all of this.
Yeah, these illustrations that Nelson uses are listing 60, 70, 80 years of compounding. 2% compounding over 80 years is a really, really big difference on the amount of money that we're talking about putting in. This brings us to chapter 18, where Nelson compares and contrasts the monetary value of a college degree and offers an alternative, which I don't think it will work at all in today's interest rate environment. But Carlo, tell the listeners what Nelson advocated for here in chapter 18.
The scenario that he lays out is taking the $20,000 a year that you might spend on college for 4 years and putting that into a high cash value whole life insurance policy. And what he represents is you're going to end up with giant numbers, being able to draw a large income in retirement and still being able to do things like financing a car every 4 years through the policy. And that is a scenario that may have worked with the interest rates that Nelson was working with. it is not really going to be possible to do that exact scenario with the exact numbers that he's talking about. So that is, you got to take it with a grain of salt. And I would also say that this chapter, it talks about that, but it doesn't really say what your alternative is in terms of here's what are you going to do for a job instead of going to college. And also, most people, even at the time that he wrote this book, were probably not just sitting on $80,000 of cash to fund a college degree. People were still taking student loans or funding it through working a job at the same time. So all that considered, it's not to say that this is going to be a bad idea for everybody, but it might not work in today's environment.
Yeah, we definitely got to take his illustrations with a grain of salt, but it's not just his. You take any illustration with a grain of salt, even the ones that we do today. I think the illustrations do good at showing what the policies can potentially do and how they work. But don't expect that those numbers will play out. They'll do better or they'll do worse. It just depends on where the dividends fall in relation to what gets projected on those illustrations. The main thing with Chapter 18 is planting the seed that IBC offers you potentially a different approach. You might have the traditional approach that says, save up this money, send your kid to college. That's the key to success. And there could be other avenues that you may want to explore. If you start earlier, maybe you don't have kids yet, and you're thinking you're going to start saving when they are first born, and you're saving a couple $1,000s a year. By the time they get to college age, you have that money saved up for college. Now you can think about what is the alternatives that we can do for this instead of paying for college. Maybe they do a trade school and they can get a decent enough income that if you put that money aside into an investment, or if you had started on a whole life policy way back when they were first born, you've got other options to consider that they don't necessarily have to take that money out for college and live a good life.
And I think in today's environment, especially with AI and whatnot, the trades are on the rise again. And there's nothing against that. I think there is great credit to getting into trades that can be very high paying jobs. And if you did that properly, where you saved a whole bunch of money that might be for your children's college, it could be a good idea to instead put that into some kind of IBC policy and help your child be successful in a trade career.
So Chapter 18, use that for thinking outside the box, giving you some ideas. Chapter 19 deals with, what if somebody is uninsurable? What can you do? Can you still start an infinite banking system?
This chapter is something that is completely applicable to today. And the gist of it is, if you're uninsurable or your spouse is uninsurable, opening policies on people who you have an insurable interest in, your children or your grandchildren possibly, these are possibilities that you can do policies that are going to have successful cash growth and be part of that family banking system. So it really, this is, of all the chapters that we're talking about today, I think it is one of the most applicable in today's environment.
Yeah, he doesn't give all the examples, but essentially, if you're uninsurable, you can get a policy on anybody you have an insurable interest in. That can include brothers and sisters, parents, grandparents, children, grandchildren, business partners, and employees. So there's a lot of things to choose from when it comes to getting around the problem of uninsurability. And to finish this off, Chapter 20, points to consider. There's a number of things that it just goes over to wrap things up. We have 7 in particular that we've identified.
Number 1 is a focus on having money at work. And what that means, and that's really where the power of these infinite banking policies is, you have this ability to put large amounts of funds into these, and they're working for you and still can serve as something like your emergency fund. So you're getting that compound interest, and that money is working for you for more time and as much time as is possible.
Number 2 is putting more money into the tax-free system. The more you put in, the more benefit it is, because eventually everything can be recovered tax-free. That just means You fund the policy, you're going to let it grow, and eventually you're going to be able to pull out a lot more money than you put into it.
And number 3, the ultimate goal, as according to Nelson Nash, is to have all of your income flowing through this banking system. It's not to say that that is for everybody. You may or may not choose to do something like that, but by virtue of doing these policies and never losing access to this, you can find that you can significantly increase your savings rate. And that applies to how I approach things in my own life because of the fact that I never lose access to the funds.
Yeah, he actually says running all business through your own bank. But yes, the ultimate goal being your life insurance premiums equal your annual income. Number 4, he reiterates, be suspicious of government-created tax-qualified plans. Again, this is one of the things that we kind of disagree with. It's good for marketing purposes or selling life insurance, though.
Yes. And number 5, wealth should reside in a controlled, liquid, tax-advantaged place like dividend-paying life insurance. And this is for the purpose of being able to finance other investments. So a lot of these things are connected. When we are earning inside of that policy, we have some tax advantages by virtue of that, but we also have that liquidity to fund other cash flowing activities.
Number 6, you finance everything you buy. Control the finance function in your life. That's the infinite banking concept in a nutshell. You've got to take over the financing function that is otherwise what a bank provides, and they get all the monetary benefits as such. Now it's time for us to take it on ourselves and get the financial benefits.
And number 7, solving your need for finance will automatically result in abundant life insurance protection. This is a really big one. I was previously what I would consider underinsured because I always looked at it as this expense. And now that I don't look at it as just an expense, it is an asset. I actually have a good amount of life insurance, and I am excited about that because of the power that it enables. So I think that most people are probably underinsured when you consider for the math of having the right amount of death benefit to sustain your family in the event that you pass away.
And I think this is something both of us absolutely agree with. The success of your infinite banking system is going to depend on your behavior and how you manage that system. There's enough guarantees, if you are using a whole life insurance policy, that it will be successful no matter what happens to that actual life insurance company. So make sure that you do a good job of managing your own bank and enjoy the fruits of that success.
Yeah, that is the crux of this whole thing, is that this concept is not just a product. It is a concept. That's why we use that language. So understanding the concept is the main key to having success in this. And obviously, get in touch with and have a discussion with an agent who specializes in proper design, because even with the proper concepts, your chances of success can be greatly diminished if you get a very poorly designed policy. Keep that in mind, and I think that's a good thing to take forward if you are interested in implementing this system.
Yeah, when it comes to a proper design policy, it's more, in my mind, of the emotional effect that we have with our money. When we have a well-designed policy and we can see that cash just growing so quickly and it's available if we need it, you get excited about funding it, as opposed to putting your money into something that has a very expensive design, is slow to grow in cash value. When you have financial turbulence in your life, it feels like an anchor. And you know that if you just get 20 years into it, everything will be okay. But getting past that first 10 years is a chore. And a lot of times people just lose the motivation to fund a poorly designed policy that doesn't grow in cash value very quickly.
And I'll say, I do have a video that breaks down some of these design comparisons. And it's exactly that, where if you have one of the poorly designed policies that is showing zero cash value in year one, that can be a really kind of, it can hurt your psyche. And impact your desire to fund it over the long term. But in the long term, if you actually just follow that policy, it still could be pretty good. But it just makes it harder to continue that as you see those low yields in those first few years.
That wraps up this book, Becoming Your Own Banker by Nelson Nash. Hopefully now you're motivated to look into it. Maybe you're ready to talk to somebody. Odds are the agent that you talk to owns a policy and does practice infinite banking. They should. If you're planning to do it and you want to get advice from them and maybe look to them as an example, next week, we're going to answer the question, should you buy the same policy design that your agent owns? And we're pulling back the curtain on life insurance here. And so we're going to talk about how the different designs might be affected if you're an agent or if you're a client, where the money's going, and what might be needed to help best meet your infinite banking needs. Be sure to join us next week for that. Wrapping this one up, I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.